million people have accounts at Robinhood. That's more accounts than E-Trade and only a little less than the 12 million or so at Schwab or Ameritrade.
Robinhood revolutionized the stockbroker industry. During the early 2010s, when legacy brokerages charged an insane $10 to $20 per trade, Robinhood offered zero commission trades. It was one of the hottest IPOs of 2021 and raised $2 billion at a $32 billion valuation.
Robinhood announced it is cutting another 23% of its staff. That's a move that comes after the company posted a 44% decline.
But the story is entirely different today. Its share price is down by over 80%, and it laid off 23% of its workforce in August 2022 to save costs. On the customer side, people absolutely hate it. In Trustpilot, it has an average rating of 1.3, with a whopping 97% being 1 star, and entire subreddits are dedicated to talking about bad experiences with Robinhood. Google had to delete hundreds of thousands of negative reviews from the Play Store after the Gamestop saga. People are also starting to ditch Robinhood entirely. Its active users declined from 22 million in 2021 to 15 million in 2022. So what happened? You might think it has something to do with GameStop, but the story is so much deeper. So how did Robinhood go from making stock trading accessible for an average person to being hated by everyone? Robinhood's story starts with two founders, Vlad Tenev and Baiju Bhatt. Both of them are immigrants and met at Stanford. Vlad had a mathematics degree and Baiju majored in physics. Before founding Robinhood, they built high-frequency trading systems for hedge funds and other Wall Street firms. High-frequency trading basically means using computers and algorithms to execute trades very fast, sometimes micro or even nanoseconds. During this time, investing was difficult for small investors. If you wanted to invest $100 monthly, the trading fees would be around $10, which means you're already down 10% every time you buy a stock. When building these high-frequency systems, they realized it costs a fraction of a penny for these institutional investors to execute a trade, while an average person paid $10. Young people didn't have much money to invest and were mostly ignored by established brokerages. After the 2008 financial crisis, young people felt the system was rigged, and the hate against big corporations and Wall Street grew. This would reach a boiling point in 2011 when the Occupy Wall Street movement started and people started protesting against Wall Street. According to Robinhood's website, the founders realized how rigged the system was and how Wall Street insiders enjoyed low trading costs while an average investor paid $10 per trade.
When we first started Robinhood, which was several years ago now, we had lived through the financial crisis of 2008, and we had seen how the younger generation had felt really frustrated, disenfranchised with the way that the system worked.
Ironically, Robinhood's greatest PR nightmare would be about it helping Wall Street insiders rig the system, but more about that in a minute. During this time, free apps like Facebook and Clash of Clans were exploding in popularity, and these were highly profitable because they found a different way to monetize users, so a market for commission-free trade clearly existed. Since the founders had a solid background, they started working on it right away. When people heard about a commission-free trading app, everyone was excited. Aside from free trades and no minimum balances, the founders greatly emphasized the app's UI. If they wanted the app to appeal to regular people, it needed to be extremely easy to use and intuitive. Baiju says his goal with the app design was to make it, quote, dead simple. Whenever he came up with a new feature or design, he'd run it over to Stanford from Silicon Valley to have random college students test out the feature. Not only did this allow Baiju to develop an intuitive app, but the app was also fun to use. You got confetti whenever you bought new stocks, and Baiju paired this with clever vibrations and haptic feedback that kept the users engaged. Some of you might have already seen the problem with this. Investing is supposed to be boring, and the data is clear. The more you trade, the less money you will make. So making trading accessible and encouraging users to do it often made it addicting. Robinhood would later face charges for gamifying investments, which was great for appealing to and retaining new users, and with that, the duo was ready to launch Robinhood. While Robinhood's UI was phenomenal, it needed to attract users in the first place to appreciate that UI. How many of you remember Clubhouse, the bizarre version of Zoom that blew up in the pandemic just because of its exclusivity? Robinhood used a similar approach in marketing its product. Since they were not funded by VC yet, blowing money on paid ads was out of the question, but they had a valuable app. So the founders capitalized on the exclusivity marketing strategy. People who wanted to use Robinhood were placed on a waiting list, and they could move up the waiting list by referring friends and family to Robinhood. Microsoft is doing something similar with its search browser Bing today. We have a full video on how Bing could beat Google doing it, so watch that too. Coming back to Robinhood, this strategy made the original launch easier to handle from the back end, thanks to a limited user count. It also gave people who made it through the cut exclusivity, which is extremely powerful. Naturally, we crave exclusivity because it gives us a sense of belonging, importance, and a certain level of social clout. Every luxury company milks this instinct to the max, and even apps like Gmail got a head start doing this. Following their initial launch in 2013, they built up a waiting list of 50,000 people. And what comes after such massive growth? VC firms, with their large checks, of course. Robinhood started to gain some serious VC attention. In 2014, they raised $13 million, which allowed them to start working on their mobile app. By the time they launched on the Apple App Store, this number had reached a mind-boggling 1 million users, and Robinhood started to aggressively market itself and invest in R&D, which paid off. In 2018, for example, they started rolling out the infamous Robinhood Crypto, which would help massively in its growth. And in late 2019, they launched fractional shares, which allow you to buy shares of expensive companies for as little as $1. The new funding also allowed them to start their famous free stock referral program that finance YouTubers push down your throat. All these new features made Robinhood more and more established within the stock brokerage industry. And that's when the pandemic hit. With Papa Powell firing up the money printer and people stuck at home with stimulus checks, everyone wanted to invest in the stock market. The market initially crashed but quickly rebounded, and we saw one of the most insane stock market rallies in history, and everyone was trading on Robinhood. During this time, cryptocurrency was experiencing a massive surge as well, and people used Robinhood for that too. For a while, Robinhood looked unstoppable. Its users increased from 13 million in 2020 to 22.5 million in 2021, a 73% increase. But Robinhood had a problem. Robinhood offered commission-free trades to everyone, so how did it make money? I looked up how Robinhood explained this to people during the early days and found a very deceiving Forbes article interviewing the founders. It was published in 2014, so right at the start. The founders don't mention payment for order flow even once. This is the main way Robinhood makes money. We'll discuss that in a second. Instead of talking about this, they give vague answers like Robinhood doesn't have the same admin expenses as legacy brokers, and they eventually plan to introduce a paid version, but that doesn't make enough money. So what is payment for order flow? Think of it as how Google and Facebook make money, but for the investing world. Google and Facebook make money by selling your data to advertisers. Robinhood does the same with your trading data. They sell it to market makers who match your trade. Payment for order flow is actually illegal in many countries, including the UK, Canada, and Australia. The problem with this is you don't actually get free trades. You're just charged indirectly. Let's say you want to buy one share of Microsoft for $100. If this order executes, that means that the market maker was able to find someone that was willing to sell one share of Microsoft for $99.40, or even $99. This gives the market maker 40 cents to $1 worth of profit, which they'll split with Robinhood. The difference between how much you're willing to pay and how much the seller is willing to sell for is called the bid-ask spread, and the market makers have been leveraging such disparities for decades. Usually this isn't a problem because market makers only made a penny or two from each share, but given that market makers working with Robinhood have to split their profits with Robinhood, their bid-ask spreads are generally way larger. A Wall Street Journal study found that Robinhood spreads were as much as 60 times larger than Charles Schwab's. Now let's talk about the security of Robinhood. The security is sloppy at best. Robinhood confirms hackers managed to get the email addresses of 5 million users from Robinhood in a phishing attack, but Wall Street Bets is where Robinhood's sloppy security is exposed in crazy ways. At this point, Robinhood should use Wall Street Bets as a bounty hunting platform where people are rewarded for finding bugs. If you don't know what Wall Street Bets is, it's basically a subreddit where people talk about investing, and most of it is YOLOing life savings into a single stock or options. One user named Irony Man found a way to get an infinite margin loan by finding a loophole in Robinhood's system. A few years later, another user named Control the Narrative found a similar glitch. One such glitch would cause a much more devastating outcome, though. Alexander Kearns was a university student at the University of Nebraska, and he had lost some money trading stocks in Robinhood. But when he opened his trading account one day, he saw a $730,000 negative position. He committed suicide instantly. and blamed Robinhood for what happened. The worst part was, it wasn't even real. It was a glitch that would fix itself. Robinhood's customer service is also horrible, to say the least. If you look at the endless reviews in Trustpilot, one theme is clear. Everyone is fed up with Robinhood's non-existent customer service. But Robinhood was about to have its biggest PR disaster ever. During the pandemic, stock trading had become popular, and Wall Street Bets was blowing up as people making and losing an insane amount of money was a common sight there. A user by the name of Deep Fucking Value was buying up Gamestop shares and continuously posting updates. He noticed something interesting though. At the start of January 2021, GameStop had a massive short interest, and if enough people bought it, its price would rise to trigger a sort of squeeze. The sentiments against Wall Street was also high in this subreddit, and somehow the short squeeze worked. GameStop's shares soared by more than 6,000% at its peak, and hedge funds lost big.
It's been a painful ride for investors betting against GameStop.
Let's start off with what is almost bordering on the ridiculousness here. GameStop trade.
GameStop surging another 51% today, the record move driven by a retail rebellion.
Most of these trades were executed using Robinhood, but Robinhood got very unlucky here. It restricted users from buying GameStop when it peaked at $300. This was due to Robinhood not being able to meet margin requirements, but people didn't care. Everyone was outraged, and many blamed Robinhood for massive losses. It didn't help that Robinhood's biggest customer, Citadel Capital, was also an investor at Melvin Capital, the hedge that lost the most in this squeeze. People suspected Citadel pressured Robinhood to halt trading and began leaving the platform en masse. Although every other online brokerage firm restricted trading, only Robinhood came to the spotlight. Robinhood suddenly became the insiders, and they were helping hedge funds screw over the little guy. By this time, many competitors had entered the race, and Robinhood didn't have anything unique to offer. In fact, new companies like Webull and Public.com were advertising aggressively, so people switched without hesitation. Robinhood experienced one final surge when Dogecoin blew up in mid-2021, but after that, it has been going downhill for Robinhood. It already had a terrible reputation for customer service and security before this. And as more competitors are entering the race, Robinhood is just a generic choice. In August 2022, it fired 23% of its staff, and executives are scaling back on plans and compensations. The stock is down 83%, and markets in general have gone down, so it will be interesting to see how Robinhood will handle this in the coming years. So what do you think about Robinhood? Do you have any bad experiences using it? Comment that down below, and don't forget to subscribe for more videos like this.